Imagine it's October 1930. You're a grain farmer in rural Nebraska named Harold. You've worked this land for 30 years. Last month, you sold your harvest and deposited $4,200 into the First National Bank of your small town. That money represents an entire year of labor. It's your seed money for next spring. It's your family's survival through winter. On Tuesday morning, you drive into town to withdraw $80 for supplies. There's a line outside the bank, a long one. People are murmuring. Some are shouting. The doors are locked. A handwritten sign taped to the glass reads, "Closed until further notice." You push to the front. You knock on the door. A bank clerk inside shakes his head, won't make eye contact, and walks away. Your $40,100 is still inside. You can see the vault from the window, but you will never touch that money again, not $1. The bank has failed. Your deposit is gone. There's no insurance. There's no recourse. There's no appeal. Within 2 years, 9,000 American banks will close their doors exactly like this one. 1/3 of all the money Americans thought they owned will simply vanish, not lost in the stock market, not gambled away, deposited, trusted, and then erased. This is documented history. And the reason it matters now is because the legal and structural conditions that made 1929 possible have not been eliminated. They have been obscured. They have been rebranded. But the fundamental architecture remains the same. When you deposit money into a bank, you're not storing your money. You are lending your money to a private corporation. You become an unsecured creditor. And unsecured creditors are last in line when the institution fails. This isn't theory. It's contract law. Once you see the pattern, you can't unsee it. Let's begin with what most people believe. The common assumption is that money in a bank is safe. It's there. It's yours. You can access it any time. The building is solid. The vault is thick. The government insures deposits. The system has been fixed since the Great Depression. That was almost a century ago. Surely, we've learned. This belief is the product of careful design. Not careful banking, careful messaging. The truth is more uncomfortable. Now, when you deposit cash into a checking or savings account, you are entering into a contractual agreement. The bank takes your money and in exchange issues you a liability. That liability says the bank owes you. But the cash itself now belongs to the bank. It becomes part of their balance sheet. They can lend it, invest it, lose it. You're now a creditor waiting to be paid back. Most people don't realize this because the system works seamlessly 99.9% of the time. You swipe your card. The money appears. You transfer funds. They arrive. The illusion of access feels like ownership, but there's a difference between access and ownership. Access can be revoked. In bankruptcy law, depositors rank below secured creditors, below derivative counterparties, below many other claims. If a bank becomes insolvent and is liquidated, depositors may receive pennies on the dollar or nothing at all, depending on what remains after senior claims are satisfied. Now, you might say, but we have deposit insurance, the FDIC. That's true, and we will examine exactly what that means. But first, let's return to 1929. The crash of October 1929 is remembered as a stock market event. Black Tuesday, the Dow falling 12% in a single day, headlines, panic, brokers jumping from windows. But the real economic devastation didn't come from the stock market. It came from the banking system. And it came slowly. In 1929, the United States had roughly 25,000 commercial banks. They operated under a system called fractional reserve banking. Here's what that means. When you deposit $1,000, the bank doesn't keep $1,000 in a vault waiting for you. It keeps a fraction, maybe 10%, and lends out the rest. That's $900 now out the door, issued as a loan to someone else. That borrower deposits their money into another bank. That bank keeps 10%, lends out the rest. The cycle continues. $1,000 in original deposits can generate $8,000, $9,000, even $10,000 in total credit across the system. This is called the money multiplier. It's how modern banking creates money. It works beautifully in calm conditions. Everyone trusts the system. Withdrawals and deposits roughly balance. The bank earns interest on loans and pays you a fraction of that interest. But the system has a fatal vulnerability. If too many depositors want their money at the same time, the bank cannot pay. The money isn't there. It's been lent out. The loans are long-term. The deposits are short-term. This is called a duration mismatch. And in 1930, it began to unravel. The first wave of bank failures hit in late 1930. A single large bank in New York, the Bank of the United States, collapsed in December. Despite its name, it was a private institution, not a government bank. It had over 400,000 depositors. When it failed, rumors spread, confidence cracked. In small towns across the Midwest and South, depositors began to worry. They started withdrawing their money just in case. But just in case became a self-fulfilling prophecy. When enough people withdraw, the bank runs out of reserves. It cannot meet its obligations. It fails. And when one bank fails, depositors at nearby banks panic. This is a bank run. And in the early 1930s, it spread like wildfire. Between 1930 and 1933, more than 9,000 banks failed. Total deposits wiped out exceeded $7 billion, which in today's terms would be well over $140 billion. These weren't speculative losses. These were savings accounts, business accounts, payroll accounts. The money people thought was safe. Think about what that means. You didn't invest. You didn't gamble. You did the responsible thing. You saved. And the system erased it. Why didn't the government stop this? Because there was no mechanism in place. No deposit insurance. No coordinated lender of last resort willing to intervene on a mass scale. The Federal Reserve existed, but it failed to act decisively. Some historians argue the Fed actually tightened conditions when it should have loosened them. There's a deeper structural point here. Fractional reserve banking is inherently fragile. It creates more claims on money than money actually exists. In normal times, this works because not everyone demands payment simultaneously. But confidence is the load-bearing wall. The moment enough people doubt the system collapses under its own mathematics. This is the hidden mechanism. Banks don't fail because they're poorly managed, although that helps. Banks fail because they're running a maturity mismatch by design. Short-term liabilities, long-term assets. It works until it doesn't. Now, here's where it gets uncomfortable. In 1933, the U.S. government responded by creating the Federal Deposit Insurance Corporation, the FDIC. This was meant to restore confidence. If your bank fails, the government will reimburse you up to a certain limit. Originally, it was $2,500. Today, it's $250,000. Most people believe this solves the problem. If my bank fails, I'm covered. Let's examine that belief carefully. The FDIC is an insurance fund. Like all insurance funds, it has a balance. As of 2023, the Deposit Insurance Fund held roughly $116 billion. That's the pool of money available to cover failed bank deposits. Total insured deposits in the U.S. banking system exceed $10 trillion. That means the insurance fund covers roughly 1.1% of insured deposits. The system is not designed to survive a systemic crisis. It's designed to survive isolated failures. One bank here, one bank there, scattered, manageable. If multiple large institutions fail simultaneously, the math doesn't work. The FDIC would need to borrow from the Treasury, which means the Federal Reserve would likely need to create new money. That's not insurance, that's a bailout. And there's another layer to this. When Silicon Valley Bank collapsed in March 2023, roughly 94% of its deposits were uninsured. They exceeded the $250,000 limit. The government intervened and made all depositors whole, but this was a discretionary decision. There was no legal requirement to do so. The government created a new emergency facility, used the systemic risk exception, and backstopped the deposits. But they also made clear that this was a response to systemic contagion fears, not a guarantee for the future. So ask yourself, if your bank fails tomorrow and your deposits exceed $250,000, what happens? The answer is, it depends on who's in charge, what the political calculus is, and whether the failure is deemed systemic enough to warrant intervention. That's not safety. That's uncertainty with a veneer of confidence. And for those with deposits under $250,000, the insurance exists, but the process can take days or weeks. In the meantime, you have no access. Your money is frozen while regulators sort through the wreckage. Ask Harold from Nebraska how that feels. Now let's look at what happens elsewhere. In 2013, Cyprus experienced a banking crisis. The two largest banks were insolvent. The European Union, the European Central Bank, and the International Monetary Fund imposed a bailout with conditions. For the first time in modern Western banking, depositors were directly hit, not through inflation, not through devaluation, directly. Deposits over 100,000 euros were forcibly converted into bank equity. Some depositors lost 47.5% of their uninsured balances, overnight, without warning. This was called a bail-in. The term is important. In a bailout, the government injects money to save the bank. Taxpayers pay. In a bail-in, depositors and creditors pay. Their claims are converted or written down to recapitalize the institution. After Cyprus, the European Union formally adopted bail-in rules as part of the Bank Recovery and Resolution Directive. The United States has similar frameworks in place under Dodd-Frank and the Orderly Liquidation Authority. These rules exist. They are documented. They mean that in a crisis, your deposits can be used to stabilize the institution. And here's what most people miss. These rules are not emergency measures. They are the preferred resolution mechanism. Regulators view bail-ins as preferable to taxpayer-funded bailouts. The political cost of bailing out banks is enormous. The political cost of quietly haircutting depositors is much smaller, especially if those depositors are corporations, foreign entities, or the wealthy. Now, let's address the practical question. If banks are not perfectly safe, where do you store cash? This is not financial advice. This is historical and structural analysis. What follows are descriptions of mechanisms, not recommendations. Physical cash. The oldest method, paper currency held outside the banking system, it cannot be frozen, it cannot be bailed in, it cannot be digitally seized. But it has drawbacks. Cash can be stolen, cash can burn, cash earns no interest. And in an inflationary environment, cash loses purchasing power every year. During the Great Depression, those who held physical cash actually benefited. Prices fell. Deflation increased the purchasing power of money. Cash was king. But in inflationary collapses, like Weimar Germany or Zimbabwe, holding physical currency was the worst possible choice. The bills became worthless faster than you could spend them. So the question is, what kind of crisis are you preparing for? Deflationary collapse favors cash. Inflationary collapse destroys it. Treasury securities, direct obligations of the U.S. government, treasury bills, notes, and bonds. When you buy a treasury, you are lending to the federal government, not a private bank. These can be purchased directly from the Treasury through a system called Treasury Direct. No intermediary required, no bank holding your assets. In a banking crisis, treasuries are generally considered the safest dollar-denominated asset. The U.S. government has never defaulted on its debt. The dollar is the global reserve currency. Treasuries are the collateral backbone of the entire financial system. But there's a catch. If you hold treasuries through a brokerage, you're relying on that brokerage to remain solvent. If the brokerage fails, your assets should be protected under SIPC insurance. But the process can be slow and uncertain. If you hold treasuries directly through Treasury Direct, you eliminate the intermediary risk. But accessibility becomes an issue. Selling quickly is harder. The interface is archaic. Money market funds. These are mutual funds that invest in short-term, high-quality debt. They are often perceived as cash equivalents, but they are not the same as bank deposits. They are securities. In 2008, the Reserve Primary Fund, a major money market fund, broke the buck. Its net asset value fell below $1 per share. Investors panicked. Redemptions were frozen. The government intervened to stabilize money markets. But again, that intervention was discretionary, not guaranteed. Gold and precious metals. Physical gold has been a store of value for thousands of years. It cannot be printed. It cannot be defaulted on. It exists outside the banking system entirely. During the 1930s, gold was one of the few assets that held value. But there's a historical complication. Well, in 1933, President Franklin Roosevelt issued Executive Order 6102, which made it illegal for Americans to own gold bullion. Citizens were required to surrender their gold to the Federal Reserve in exchange for paper dollars. This is not speculation. This is law. Look it up. Executive Order 6102. The government can, and has, outlawed the private holding of gold. It can do so again. Silver has similar properties, but is more volatile. Platinum, palladium, and other metals are niche. If you choose precious metals, you must also solve the storage problem. Where do you keep them? In a bank safe deposit box? That's still inside the banking system. During bank holidays, safe deposit boxes are often inaccessible. Foreign currencies and foreign accounts. Some individuals diversify by holding cash in foreign banks or foreign currencies. Swiss francs, Singapore dollars, jurisdictions with strong property rights. This adds geopolitical diversification, but introduces complexity. Currency risk, reporting requirements, foreign legal systems. Americans are required to report foreign bank accounts exceeding $10,000 on the FBIR. Failure to comply carries severe penalties. Offshore banking is legal but heavily regulated. Real assets, land, property, commodities, things that exist in the physical world, these are not liquid. You cannot spend a farm, but they cannot be bailed in. They cannot be frozen. They have utility beyond financial value. In hyperinflationary environments, real assets have historically outperformed financial assets. In deflationary environments, they often fall in price due to lack of buyers and credit contraction. Here's the uncomfortable truth. There is no perfect solution. Every option has trade-offs. Every safe haven has conditions under which it fails. Physical cash is vulnerable to inflation and theft. Treasuries depend on government solvency and your ability to access them. Gold can be confiscated or made illicit. Foreign accounts expose you to currency risk and regulatory complexity. Real assets are illiquid and can fall in value. The trap is this. The system is designed to keep your assets inside the system. Tax incentives, convenience, social norms, fear of being seen as paranoid. Holding cash outside a bank feels strange. Buying gold feels eccentric. Opening a foreign account feels suspicious. And yet, history shows that those who diversified, who maintained optionality, who did not place all trust in a single institution, fared better. Not because they predicted the crisis, but because they prepared for uncertainty. In every banking crisis, the cost is distributed, but not evenly. In 1929 through 1933, the people who paid were small depositors in small towns. They had no political power, no legal representation, no access to insider knowledge. They trusted the system and the system failed them. The wealthy, in many cases, saw the signs earlier. They moved money into government bonds, into gold, into safer institutions. They had options. In Cyprus, it was the same pattern. Large uninsured depositors, many of them Russian nationals and offshore businesses, were hit hardest. But ordinary Cypriots also lost access to their savings for weeks during capital controls. ATM withdrawals were limited to 300 euros per day. In Argentina, in 2001, the government froze all bank accounts in what was called the Corralito. Peso deposits were forcibly converted to devalued currency. The middle class saw their savings evaporate. In each case, the people who paid the price were those who trusted the system without understanding it, those who assumed safety, those who didn't ask questions. This is not a moral judgment. It's a structural observation. The system does not protect the uninformed. It extracts from them. Let's return to structure. The modern banking system is more interconnected than ever. Derivatives markets exceed $600 trillion in notional value. Banks hold assets from each other. Failure cascades are faster and harder to contain. Interest rate risk has emerged as a silent killer. When rates rise rapidly, as they did in 2022 and 2023, the market value of long-duration bonds falls. Banks holding these bonds face unrealized losses. Silicon Valley Bank held over $90 billion in securities. When rates rose, those securities lost market value. When depositors wanted their money, the bank was forced to sell at a loss. The losses triggered panic. The panic triggered a run. The run triggered collapse. This happened in 48 hours. The Federal Reserve created emergency facilities to stop contagion. The Bank Term Funding Program allowed banks to borrow against underwater securities at face value. This prevented immediate collapse, but did not resolve the underlying losses. The losses are still there. They are just hidden. As of mid-2023, unrealized losses in the U.S. banking system exceeded $500 billion. Not all banks are equally exposed, but the fragility is structural. The duration mismatch remains. And here's the constraint. If inflation persists, the Fed must keep rates elevated. That keeps the pressure on bank balance sheets. If the Fed cuts rates to relieve banks, inflation may reignite. The dollar may weaken. There are only two paths. Neither is painless. That's the trap. History doesn't repeat, but it rhymes. In 1929, people trusted banks because banks had always been there. Failure was unthinkable until it happened. In 2008, people trusted mortgage-backed securities because they were rated AAA. Failure was unthinkable until it happened. In 2023, people trusted regional banks because they were regulated. Failure was unthinkable until it happened. Each time, the system found a way to reassure. Each time, the reassurance was partially true and partially illusion. Deposit insurance exists, but it has limits. Regulation exists, but it has gaps. Central banks exist, but they have constraints. The question is not whether the system is safe. The question is, under what conditions does it fail, and what happens when it does? If you understand the conditions, you can prepare, not predict. Prepare. If you don't understand the conditions, you are Harold in Nebraska, waiting in line, knocking on the glass, watching your savings disappear. This is historical and educational analysis. It is not financial or investment advice. Nothing in this presentation should be interpreted as a recommendation to buy, sell, or hold any asset. Consult a qualified professional before making financial decisions. The banking system is not evil. It is not a conspiracy. It is a machine. Machines do what they are designed to do. Fractional reserve banking creates credit. It fuels economies. It also creates fragility. When confidence breaks, the machine breaks. The question isn't whether you trust banks. The question is whether you understand what a bank actually is. A bank is not a vault. It's a counterparty. And counterparties can fail. Those who understood this in 1929 held cash, held gold, diversified, reduced exposure before the doors closed. Those who didn't understand lost everything. The mechanisms haven't changed, only the names. Deposit insurance is confidence management. Bail-in authority is loss distribution. Emergency lending facilities are system stabilization. The language is modern. The structure is old. And the constraint remains. When too many people want out at the same time, not everyone can get out. Think about what that means. The pattern is already in motion. The question isn't if the next crisis will come. The question is whether you understand where your money actually is when it does. Most people never study the mechanics of failure until they're living through one. This channel exists to examine the autopsies while there's still time to learn. If that matters to you, consider subscribing.